Are we in a stock market bubble in 2021? Well, a vaguely worded tweet from billionaire Elon Musk has caused the share price of a virtually unknown company to skyrocket, so Musk encouraged his followers to use Signal. Now, while he meant the encrypted messaging app Signal, investors misinterpreted the tweet to mean Signal Advance, a medical device firm completely unrelated. This caused Signal Advance's shares to go from around 37 pence a share to nearly £30 just in the matter of a few days. So if you put in £100, it will be worth nearly £8,000 or nearly 80 times your money. And when investors realized, they quickly sold off, causing the price to drop by nearly 80%. But even now, the company is at £10 per share, which is still significantly higher than their 40 pence share price only a few weeks ago. Now, what I'm going to share with you today is my thoughts on whether the stock market is in a bubble in 2021. We'll be looking at what happened in the dot-com boom, the real estate bubble, and the Bitcoin bubble. We'll also be looking at the first ever recorded financial bubble, and we'll be taking a look at Tesla's crazy PE ratio. We've already seen what happened to Signal Advance. We'll also look at why the Hertz stock soared after they went bankrupt, and how the stock with ticker symbol ZOOM shot up because retail investors, such as the average Robinhood investor, they thought they were investing into Zoom, the video conferencing company, but it was not Zoom they had invested in. So, if all of that sounds good to you, then do make sure to stick around till the end. Hey, what is up people? Welcome back to our channel, Ralph Finance UK. So let us get straight into it. Bubbles usually start with something simple and then people hear that it's the new hot investment. People then start pouring money into it without questioning anything really, in the hopes of making some quick profits. Prices soar and the bubble inflates, and eventually when people begin to question what they have bought, the bubble peaks before bursting as prices shoot back down as people start panic selling. Now, a company's stock price depends on a few factors. Now, one of them is the strength of the company. You also have to factor in the number of investors, and overall, you have to consider the strength of the economy. But ultimately, it is just supply and demand. When you have more buyers of a stock than sellers, the price of a stock will go up. And when you have more sellers than buyers, the price of that stock will go down. So ultimately, it does come down to how many buyers and sellers there are. Now, a bubble occurs when the price of an asset is going up and people do not question what the real intrinsic value of that asset is. And so this leads to people massively overpaying for something that actually has a much lower intrinsic value. The price rises and rises until people start to question and realize what they're doing. And that is when the price abruptly plummets. And economists call this a bubble. Now, when a company goes bankrupt, its stock typically becomes worthless, which makes logical sense. So when Hertz, the US car rental company, when they filed for bankruptcy in May 2020, the stock price responded accordingly. I mean, it dropped by 80% within 5 days. Logical sense. However, what happened next does not make logical sense. Within 5 days, the Hertz stock shot up by a colossal 570% from its bottom, and it was now worth more than double what it was before it filed for bankruptcy. Did the company double its profits from before it went bankrupt? Now, this is because retail investors started buying up the Hertz stock as they saw it as being cheap, and the Hertz stock just rallied. And it was actually so crazy that Hertz actually tried to sell £370 million of their own worthless bankrupt stock to speculators on the stock market just to raise some cash. However, these plans were put to halt by the SEC, which is the US Securities and Exchange Commission. Now, another example is that when the pandemic first hit, Zoom, the video conferencing company, they became very popular as people were staying indoors and video chatting to one another. And so investors saw this as an opportunity to invest in Zoom stock, and retail investors followed suit. However, retail investors started buying up shares of the stock with ticker symbol ZOOM, thinking it was Zoom. But what they were actually buying was a completely unrelated penny stock. The penny stock started rallying, and then the SEC yet again had to intervene. This is the consequence of people just not doing their research. Now, the PE ratio, or the price per earnings ratio, is a way to value a company, and it can show whether a company is overvalued or undervalued. The PE ratio is simply how much an investor is willing to pay for £1 of profits, and it can also be used as a measure of the number of years an investor is willing to wait to earn back the purchase price if the company had zero growth. Now, a high PE ratio indicates either that investors are willing to pay a higher share price today because of growth expectations in the future, or simply that the company is overvalued. So let us consider the S&P 500, which is the top 500 companies in the US. Now, the reason we're looking at the S&P 500 rather than our UK stock market is because of the same thing I say every time on this channel. Apple, just a single US company, has a larger market cap than the entire FTSE 100, which is the 100 largest companies in the UK. And so we can't just restrict ourselves to the UK stock market, we have to look beyond. Now, the historic average PE ratio for the S&P 500 has been 15, and currently it's near 40. That means it would take 40 years for the shareholder to earn back the purchase price. Now compare this to Tesla, for whom the PE ratio had reached nearly 1,800, and even now it is at just over 1,600. So that means an investor is willing to pay £1,600 for £1 of profits. In other words, an investor is willing to wait 1,600 years to earn back what they paid for the stock. Now, of course, this is all provided the company doesn't grow anymore. But even if Tesla grow by a factor of 10, then investor is still willing to wait 160 years to earn back the purchase price. I mean, we saw the nearly 12,000% increase in Signal Advance's share price due to a single tweet from Elon Musk. Now, when the pandemic hit earlier in 2020, economies around the world were shut down and many businesses closed. And what happened to the S&P 500? Well, after the 30% drop from February 2020 to March 2020, the S&P 500 then proceeded to rally, and it has grown nearly 70% off its bottom. It's currently sitting 11% higher than what it was just before the pandemic hit. But has the economy really just gone back to the way it was before the pandemic hit, like nothing ever happened? Now, this is not the first time we're seeing a bubble, and it's definitely not a phenomenon that it only started in recent years. No, financial bubbles have been recorded for centuries. The first recorded financial bubble began in the 1620s, and it collapsed in 1637, and this was a bubble of tulips. Yes, tulips. And this bubble is known as tulip mania. You see, today you can buy several tulips for a couple of dollars, but back in 1637, at the height of the bubble, a single tulip could buy you an entire house. Now, the tulip was first introduced to Europe on trading vessels, and because of this it was considered to be an exotic flower. Tulips became a sort of status symbol in the Netherlands, and the price for tulips went up as everyone wanted one. Then during the 1630s, an outbreak of tulip breaking virus made certain flowers have even more exotic patterns and colours, which made these even more valuable. And it wasn't long after this that the tulip became a nationwide sensation. Now, tulip traders were trading more and more tulips, and the prices were just soaring up. When people heard of the insane amount of profits that tulip traders were making, everyone wanted to get in on the action, and this created a great influx of tulip traders. People who knew nothing about tulips had now entered the market to try to make a quick profit, and the tulip bubble grew. By the end of 1636, the prices had absolutely skyrocketed. It got to the point where people were even selling their houses to buy tulips, as they thought it was a good investment. Let's just think about that for a second. People were selling their houses to buy a flower. And so at this point, a single tulip bulb could buy you a large house, and a couple of tulip bulbs could buy you an entire street. Then on the 5th of February 1637, the price of the tulip dropped, and this caused a lot of traders to sell their tulip stock for fear of the price dropping even further. And it was at this point that the traders began to question what the intrinsic value of a tulip even was. From then, it did not take long for the price to drop, and by the end of the same night, yes, we are still talking about the evening of the 5th of February 1637, by the end of that night, prices had shot down rapidly by around 95%. 95% loss of value in a single night. And it did not take long for this to spread throughout the cities. And within 4 days, tulip prices had crashed across the country, as people started to question whether a tulip has the same intrinsic value as, say, a house. There were people who sold their houses just to buy tulips. There were people who spent everything they had just to buy tulips. And there were people who went into serious debt just to buy tulips. And now they were left with nothing except some flowers. So you start with something simple like a tulip bulb, and then people hear that it's a new hot thing. Investors then start making a lot of money, and that's when the speculators who have no idea what a tulip is, they want to get into this business. They risk everything, their house, their savings, they go into debt, all in the hope to make some quick profits. Prices then shoot up rapidly, but eventually you do hit a peak where people start to question the intrinsic value of what they have invested in. Some people start selling and the price drops, and then everyone else sees this initial drop and then they start panic selling. And once the crazy demand for, say, something like tulips, once that crazy demand goes away and the price shoots straight back down, we say the bubble has burst. I just want to say, if you are finding value out of this video, then do hit that thumbs up button. That way you get more of my videos recommended to you. Now, in more modern times, we have seen this bubble cycle repeat many times. For example, in 2001, we had the dot-com boom, where the prices of tech stocks just exploded. The Nasdaq index, which is comprised of US tech stocks, that had risen fivefold between 1995 and 2000. And from 2000 to 2002, it had lost 75% of its value. By the end of 2001, actually, most dot-com stocks had gone bust. And even the share prices of the financially stable companies such as Cisco, Intel, and Oracle, they lost more than 80% of their value. It actually took 15 years for the Nasdaq to regain its dot-com peak, which it did in mid-2015. Then in 2008 came the real estate bubble, where the prices of homes had shot up over the years, and it was at an average of £190,000 here in the UK, before dropping by nearly 20% within 1.5 years. Now, the main causes of this was unregulated growth of mortgage credit and over-leveraging. And when it crashed, many people lost their homes, savings, pensions, and jobs. And more recently, we had the Bitcoin bubble in 2017, where at the beginning of 2017, a single Bitcoin was worth around £600. By the end of 2017, a single Bitcoin was then worth just under £15,000, before losing more than half of its value in just 2 months. Now, although it is at an all-time high currently, we know it was a bubble back then, that's why it dropped. Now, before the 1980s, only the wealthy and sophisticated would have invested, as you had to know a stockbroker and you would have actually had to read pages and pages of stock prospectuses, and so it was nowhere near as accessible as it is today. Now, there was a major change in around the 80s and 90s where pension funds became popular, so now the general public could put their retirement money into these retirement accounts, and this money would then work its way into the stock market. And so now you had the average person with access to the stock market through these retirement accounts. Then in the 1990s came online brokerages like Charles Schwab, which allowed anyone with some cash to make investments by just using a phone or a computer. And today, with so many online stock brokerages and commission-free stock brokerages and ETFs that span the globe, stock market investing has never ever been more accessible. But with this easy access to investing, there are consequences, and the main one being that it brings in a lot of people who might not know what they're doing. These are known as the retail investors. Now, in the UK, the FTSE 100 has recovered from its bottom in March 2020, but it is still over 12% lower than what it was before the crash in 2020. Whereas over in the US, the bubble is just getting bigger and bigger, and the stock market keeps rallying. And also with what's happened with companies like Hertz, Zoom, and Signal Advance, it is all signs of a stock market bubble. But we have to understand the Federal Reserve, the central bank for the US, they have a part in this now. They are pumping money into the stock market to keep it artificially inflated. And also the government continue to hand out stimulus packages, which are then being poured into the stock market. So it is hard to say whether it's a bubble or not. Because if we believe the Federal Reserve won't allow the stock market to crash like they say they won't, then doesn't this just mean this is the new price? Overall, what we do know is that the S&P 500 has rallied by 70% off its bottom earlier this year, and it's currently sitting 11% higher than what it was before the pandemic hit, as if nothing ever happened to the economy. And the four most dangerous words of investing are regarded to be, this time it's different, and we are seeing the same sort of phrases being used yet again. When people start investing in an asset, and as the price goes up and you don't fall for it, all is fine until they start to make some money. And you still say you aren't going to get involved, as it's a bubble. However, as others start to make more and more money, you start to feel like you've missed out. And so now you feel like you've got some catching up to do. And so instead of directly investing in the asset, you now leverage up your investment in an attempt to catch up to others. And it's this fear of missing out, getting caught up in the hype, easy leverage and the desire to get rich quick, which is the perfect recipe for a bubble. What experienced investors do instead is they step back and view the bigger picture. They are always ready, and as soon as the bubble bursts and the prices drop down, while everyone else is panic selling and losing money and getting out of the market, experienced investors instead, they start to get into the market because they now view everything at a massive discount. And so as everything starts to go back up again after that drop, experienced investors make money during this upside. So if you found value out of this video, then hit the like button, that way you get more of my videos recommended to you, and subscribe if you don't want to miss the next one. I hope to see you on the next one. Take care.